Hello, good morning, and welcome to another live technical analysis. We're going to be starting off with the euro against the US dollar. So let's zoom in. We are now on the 4 hour time frame. We have our text labels to the right, and I'm starting off with some. Let's add an indicator. Let's add the Bollinger Bands. All right, so Bollinger Bands appear to have narrowed, moving in a sideways fashion. Moving averages as well appear to be tilted. Well, not tilted. They appear to be smoothing out. In addition, RSI 55. So you have three indicators that are implying that the pair might move in a sideways fashion, as there appears to be a neutral market sentiment. Now let's combine the financial releases that were released earlier on today. You have France's services PMI, Germany's preliminary services PMI. Excuse me, France's was preliminary as well, all for January, in addition to the manufacturing preliminary PMI figures for January as well. So, Germany and France, two largest economies of the Eurozone. As such, lower services PMI figure might be concerning, implying a widening contraction in services. Yet, the manufacturing PMI figures came in better than expected. And as such, given that perhaps more emphasis is placed on manufacturing rather than services, it might be the reason as to why the euro at this 4 hour candle is now moving higher. Some bullish market sentiment despite the lower than expected services PMI figure. And as such, you have S1 at 1.0830. Change our text label 1.0830. That could be our S1. Oh, nope. I have S1. That's 16. Then we could take S2 at this low. Let's see if it coincides with these two candles as well. I'd rather take, I wouldn't mind that it doesn't take those wicks. It's the closest next level of support that I can see. Bearish bullish candle failed to break below S1. Well, failed to break below support, moved higher, formed S1 here, and now S2. So you have S2 at 1.0740, rounded up. And actually, since we rounded it up, you can see that it's no longer on these two candles. Such 1.0742 would be more prudent. So S2. Now for S3, let's go back. Previous low. Swing low, came back down, failed to break below. Distance between S1 and S2, 84 pips and 78 pips. Not too bad. We use the wicks of one and the second wick here. The distance between S2 and S3 would be 81 pips, so equidistant as well. So you have S3 1.0655. Let's go back and make sure that this is still valid. 0.57, so I can validate our touches that we mentioned before. So those wicks. So have S1, S2, and S3. So have 1.0657 for your S3. So we have placed our support levels. For now, you could maintain a sideways bias, and I'll show you what I mean in just a moment, unless it breaks above R1, which is currently at now 1.0906 as R1. It wicked up, opened, and for a bullish outlook, it would have to break above R1. Next potential target, so roughly around here, 82 pips. Roughly the same distance between S1 and S2. So we're keeping that formant of roughly 80 pips between our support levels. 1.0980 for actually slightly higher. 1.0980 1 for our R2. And let's just place this, change this to 16. Then R1, 1.0906, as we mentioned before. So I have R1, R2, and let's place R3. Now for resistance line at R3, let's move this line. You could take this high. I wouldn't bring it to this swing high, as the distance between R2 and R3 would be too much. As such, I'd opt for my resistance level to be at a slightly lower point, upon which we could still find some resistance. So one could be at this bullish and bearish block validated by these two wicks, or in between. It closed. So there was downwards pressures that brought the price action lower. And as such, there might have been accumulation of sell orders at this point, which could make this a valid resistance level. 1.10, 1.1065 if we round it up. But if we round up, then 1.1063. So 1063. So this would be my R3. It's before, too high, and still a valid resistance level. So I said that if it fails to break above R1, it could move in a sideways fashion. And what do I mean by that? Well, there are size at 55, so it does imply a neutral market sentiment. The narrowing of the Bollinger Bands imply low market volatility. You have R1, you have S1. It failed to break above S1, below S1, and is now currently testing R1. As such, if it fails to break above R1, then we would maintain a sideways bias. If it does manage to break above R1, then we could potentially see the pair aiming for R2 at 1.0981. Further than that, you have 1.1063. So if it breaks above R1, bullish outlook up until R2, perhaps maybe even R3, breaks below S1, switching towards a bearish outlook for S2. If it fails to break above R1, we maintain a sideways bias between S1 and R1. From a technical point of view, you could maintain a sideways bias, but from the fundamentals, we could also maintain a sideways bias, as it could be that the services PMI figure might be capping the potential gains made by the better than expected manufacturing PMI figures. But overall, we can see some emphasis being placed on the manufacturing PMI figures, which could have aided the euro. So you have our support and resistance levels for the euro against the US dollar. USD CAD, so the dollar against the loonie. We know the BOC's interest rate decision is due out later on today, around an 85% probability in CAD OIS for the bank to remain on hold. The rest is for the bank to cut by 25 basis points. Now, personally, I would pay attention to the bank's accompanying statement, upon which, should it appear to be predominantly hawkish in nature, it could support the loonie, and as such, breaking below S1, aiming for S2. If it appears to be dovish in nature, we may see the dollar gaining against the weaker loonie, so aiming for R1, perhaps even breaking R1 and aiming for R2 at 1.3675. Now, we could also look at oil prices. From a geopolitical level, you have the continued tensions in the Middle East continuing to rise. And we're not talking about the conflict in Israel, we're talking about the conflict in Yemen. The UK and the US are continuing their strikes against the Houthi rebel group based in Yemen. As such, perhaps a prolonged period of time, perhaps prolonging the potential easing of tensions in the region, as such, disrupting shipping lanes, and given that main and a vital oil artery flowing through Suez, if you have an issue in Yemen and no ships are passing through, perhaps could be translated into higher oil prices. From a technical point of view, it's currently testing R1 at 75. You could place an upwards moving trend line stemming from the 17th of January. upwards moving are still below 60, but it's at 59. Such we may see some bullish tendencies in the market. Bollinger Bands tilted to the upside further imply a bullish outlook. Also note higher highs and higher lows, therefore potentially pushing the commodity to higher ground. As such, if it does break above R1, the next potential target could be at the $79.65 mark. Whereas for a bearish outlook, it would have to break below S1, but S1 at 70, although it is a very nice round figure of 70, I think we might see more support at 71.05, which coincidentally is also the beginning of this upwards moving trend line. We could keep our S2 and S3 level due to the fact that the distance between R1 and R2 is significant. As such, having S1 at 70 and 66.85 for S2 is not that far apart if you consider R2 and R3. Therefore, for a bearish outlook breaking below S1, bullish, simply breaking above R1 and moving towards R2. So a clear break, making a candle. So I would like to see two consecutive 4 hour candles remaining above R1 for my bullish outlook to be maintained for the commodity. For a bearish outlook, simply breaking below S1, sideways, failing to break above R1 or coming back in below between S1 and R1 and staying in between S1 and R1 for a sideways bias. So, from in terms of financial releases, the API weekly crude oil inventories report came in lower than expected, implying a greater drawdown than expected, thus implying greater demand, which may have aided oil prices. Therefore, oil traders may be interested in the release of the EIA crude oil inventories figure, so the weekly figure, which is due to be released later on today, should it verify expectations of the API figure as well of increasing demand, we may see oil prices moving higher. In terms of gold, as you can see, now R1, S1, and R1 levels are, I'd say, a bit too far apart in terms of the R1. I would personally bring R1 to this high here. Note heavy resistance at this point, failed, came back down, support, and is now moving in a sideways fashion between R1, which is 2055, and then you have 2013 for S1. So R1, 2055. Let's remove R3. Of 2055 for R1, 2087 for R2, and then 2135, which is the all-time high figure for R3. We could also draw a sideways moving channel. But it's too far away. Now, I won't be drawing the sideways moving channel as I'd need another point. So if it comes back up to R1 and fails to break above R1, then we could potentially place a sideways moving channel. But for now, we could also add the CCI indicator as well. Not the parabolic, commodity channel index. There we go. So if you take the CCI at face value in combination with the RSI, it's at 55. So neutral market sentiment, narrowing of the Bollinger Bands, also appears to be moving in a sideways fashion. So you have one, two, a third, and a fourth indicator all pointing towards a sideways bias for gold, and the fourth is the moving averages. Pretty flattened out, therefore potentially implying an uncertain market. So sideways between R1 and S1. So let's move that. Back to the euro. Let's also add volume. Let's see. It's rejected R1, just as we said. Bearish candle turning. Would not be surprised if it comes back down to S1 and stays between S1 and R1. Let's also add volume. So I'm guessing the volume difference was lower as well. You could also say declining volume. Therefore, we would maintain a sideways bias for the particular pair. In terms of the dollar against the Japanese yen, it's broken below our upwards moving trend line that we have placed from here. R1 readjusting to slightly higher, 146.60. Yes, R2 is fairly close to R1. Such for bullish outlook would have to break above R1 and R2. And in terms of support, we're taking this old high, keeping S1 at 146.30, 144.45 for S2, 143.0 for S3. Now let's add volume as well. The Bollinger Band, excuse me, the RSI, dropping below 50, but still not below 40. So I'd say sideways bias between S1 and R1. Indicator volume, declining volume as well, slightly. And let's add one more. So what should we add? ATR, Ichimoku. Let's see. So we'd actually have to edit the properties, visualization, blue, green, and then so Ichimoku as well. From a more macro perspective on the daily narrowing, so we may be nearing a trend reversal, so it's moving lower, might move higher. But if this widens, we would maintain a longer term bearish outlook for the particular pair. In terms of the basics, so Bollinger Bands, moving averages, you had a crossover, so moved higher, yet breaking below our upwards moving trend line. Bollinger Bands might be tilting towards the downside. You've got RSI at 50, sideways between S1 and R1, at least for now. Let's move volume as well. You have R1, R2, and then you have R3. So it's broken below. I would be bearish up until S1. If it breaks below, maintaining my bearish outlook. Whereas if it fails to break below S1, I would maintain a sideways bias for the particular pair. In terms of financial releases, nothing too major could affect the particular pair except from dollar strengthening. For the dollar, you have the S&P manufacturing PMI figure jog later on today. If it comes in better than expected, which could support the US dollar, we could see the dollar moving upwards as well. British pound, on a political level, I would be very interested in PMQs later on today. So PMQs, for those of you that may be unaware, every Wednesday the Parliament convenes, and the Prime Minister is also present, allowing lawmakers the chance to ask the sitting Prime Minister questions in regards to policy, foreign policy as well. And such is an interesting event, I'd say, that happens on a weekly basis. For now, it was moving in a sideways fashion since one could say nearly forever. This was on the 14th of December 2023. Now, we formed this channel properties. Let's not make this array. And let's make this. So it was moving in a sideways moving channel, appears to continue moving in a sideways moving channel. This was higher, corrected lower, staying in between the boundaries of the sideways moving channel. RSI 59, not 60. So some bullish market tendencies, but note that it's rejecting R1. So it would maintain a sideways bias for the particular pair, staying between S1 and R1. We spoke about the Canadian dollar and the BOC's interest rate decision. The Aussie, sideways as well. You had a crossover, but our size at 50, narrowing between S1 and R1. Now we could even bring S1 slightly higher, 0.6525 for S1. So I maintain a sideways bias for the particular pair. Staying in between S1 and R1. Oil, we said moving higher. We also spoke about gold. Personal favorite would be Boeing, which is on the news. So Boeing's credibility is in question. For our chart, and let's zoom in. So let's talk about Boeing. Ever since the issue with Alaska Airlines, Boeing's price has been Boeing's stock price has been moving lower. Why? You have issues about quality control. If you look at the news, United Airlines may be removing Boeing from its budget. So perhaps less orders for the plane from the particular company could be weighing their stock price. Furthermore, you're finding more issues with terms of quality on other airplanes and other models of Boeing as well. So you have issues after issue after issue after issue. Breakaway gap, continuation gap, moving lower. From a fundamental point of view, I would be maintaining a bearish outlook for Boeing stock price for the foreseeable future, as we may see companies perhaps canceling orders for the particular plane manufacturer, and as such, we're going to be looking at Airbus, which could pick up those orders, which could boost their stock price as a result. But from a fundamental and from a technical point of view, I would maintain a bearish outlook for Boeing. Constant issues. So it was a market correction to the mid range, bearish, aiming for S1, then S2, 176.60. If this issue persists and we find more and more problems with the company's airplanes and in terms of quality control, then could continue moving lower. Now, it might be surprising that an airplane manufacturer has had so many issues with their airplanes. But if you consider the funding that the FAA has and the NTSB, so the Federal Aviation Authority and the National Transportation Safety Board, it's not surprising. It feels like they're relying on an honor system upon which the airplane manufacturer, so Boeing, is expected to test internally the quality of their own work. And since they're profit driven, could be said and speculated that they may not be that stringent or they may be not sufficient. And the reason as to why this is supported, simply turn on the news or simply Google Boeing and you'll see why. So fundamental, technical would be bearish for Boeing's stock price. And let's add the labels as well. 16. So you have R3, 267.10. Now, the way I've determined the support and resistance levels, one, you could say that could be lower. That's fair. Taking this wick, so this high, breakaway, continuation gap. But given that the gap was filled, I would not place R1 here. I'd simply place R1 at a slightly higher level, just in case it decides to come back up higher. So this was the mid-range of the Bollinger Bands and could be considered to be a market correction. RSI, 35, bearish market sentiment. Fundamentals, we've stated before, bearish on Boeing's stock price for the foreseeable future. Turn 44.31, that's R2. Then for R1, 227.25. In terms of US politics, don't seem to be moving the markets at this point in time. What could move the markets is after the elections occur, depending on who wins the US presidential elections. We're not going to speculate as to who might win. Polls have them at neck and neck if you consider the Republican and Democratic front runners. So current incumbent President Joe Biden and former President Trump. So no impact on the markets despite the primaries in New Hampshire yesterday. That's only concerning for the Republican Party and may not impact the markets. 158.35. That's for S3. Bearish outlook for Boeing, breaks below S1, next target 176.0, S3 158.35. Moving on to Netflix. Now, Netflix, interestingly, had its earnings released yesterday. So revenue came in higher than expected, yet earnings per share were lower. On the day, it appears to have remained unchanged, forming a doji. On the weekly, they have been up, but earnings, 4 hour. Now, if EPS is lower than expected, personally, I would be bearish for the company stock price. By the way, we're going to be looking at Tesla and IBM, who are due to release their earnings later on today. So I have for Netflix 465. So that would be my S1. Then taking this lower low, actually this candle too close to S1. I'd rather have S2 at 435.25, just in case something significant happens, and we can refer to this chart in the future. Taking this point here, 397.35. I wouldn't take this high, too close to S2. Therefore, next potential support level, S3, failed to break below, open 4 hour, moved higher. This could have been a breakaway gap, but we don't see a continuation gap. So, might be something that might be a gap that might be filled in the future. Very clean bullish and bearish block. So 500.60 R1. And now let's hunt for R2. Let's zoom out. And then taking this high, 543.35. So that's R2. And then for R3, taking this low, swing low, 584.05. Now, I'm going to be drawing a rectangle so I can explain as to what I mean by that gap might be filled. So it broke lower. As you can see, it formed a gap. Now this was 16th of December 2022. If I extend this, you can see that from December 2022, a gap was formed, and then it's nearly being filled in January 2024. So a gap might be filled, which is why we referred to this before. At some point, there is a possibility that the price action might come lower and fill in this gap that was formed. For now, since we're not looking that far into the future, we're going to be keeping our support and resistance levels. So we have R3, 584.05. $543.35 and 500.6 for R1. So I have S1, we have R1, R2, and R3 now placed. You could say this is an upwards moving trend line, but you could also say that this is also a sideways moving channel. So if it breaks below our upwards moving trend line and fails to break above R1, sideways, breaks below S1, maintain a bearish outlook, RSI 58, some bullish tendencies, but would have to break above R1 for a bullish outlook to occur. So 465, that's RS1. Then you have S2 at 435.25. And then for S3, 397.35. We're going to be looking at Tesla, whose earnings are due out later on today. So you have a crossover. So this could have been a bearish signal. Now, in terms of gaps, you could have we need to add volume. The volume looks relatively equal, and that's a 4 hour, so much better. RSI running along figure of 30, so bearish market sentiment, actually resting on support 207.70. Taking this swing low 195.65. That could be S2. For S3, bearish candle validated by wick and a few others, therefore potential for it to be a valid support level 175.70. Well, let's see if it run up to 80. Still valid. We have S1 resting S2 and then S3. Bearish outlook would have to break below S1 and S2 as it is currently on S1. You could place R1 with this bearish candle 221.05. R2 244.25. It looks as if there is more resistance at this point rather than in between the price action. So you have the opening of this bearish candle to wick down lower, validated at the prior point in time, such potential for it to be a valid resistance level. 263.70, that would be MAR3, previous high. To have R1, R2, R3, S1, S2, and S3. So let's just place our support levels. $195.65. And then 175.80. $21.05, that would be R1. 44.25. If I'm not mistaken, it's expected that their earnings per share and revenue might actually increase. In such an event, you may see some support for the company's stock price. Yet, from a fundamental point of view, the issue that Tesla has been facing with unions could have increased their production costs and overall may have hurt their bottom line. So, I would not be surprised if the earnings per share and revenue disappoint. So we've placed our support and resistance levels. Let's also look at IBM for our candle on the daily. Let's see how it's doing. It's moving on an upward trajectory. Weekly continues moving higher, aiming for levels last seen in 2016. So this old high. Daily breakaway, continuation, one more for an exhaustion gap. Or this could have been the breakaway, continuation, exhaustion. Might be due reversal as well. But earnings later on today. So from a 4-hour time frame, let's place support and resistance. We noted this gap before, and as such, we're placing RS1 at 166.85. So that would be my S1. I wouldn't place it much higher. We could, but then my S2 would be far too close to my S1. Taking this wick, 157.85 for S2. Then for S3, this old high, 150.30. Now, in terms of resistance, let's go back. All time. Well, we can't go further back, so we're using the daily chart then to plot our resistance levels. So we could place, there's an accumulation of buy orders, which pushed it higher, came back down, then accumulation of sell orders, moved lower. And we could take this previous high, or we could take this low, and then came back lower. Bit of a risky proposition, but given how close these are. For our one, 176.10. Then we'll take the all-time high, 182.86. And then we're going to be extending or extrapolating the distance between R1 and R2, and then reflecting it higher to find R3 rather than having R1, R2, and R3 all within a few dollars of each other. 16, 694. 189.15, that would be my R3. So I have R1, R2, and R3. Let's add also another indicator, Bollinger Bands, and then volume. High market volatility might be due market correction. So for bearish outlook, we'll have to break S2 as well, but which is why we actually placed S1 here and not higher. And then let's add volume, declining volume, so might be due market correction. It's ascending, maybe lower. But overall, RSI 76, so maybe it's overbought. But bullish tendencies will depend on the company's earnings release later on today. And with that, I think we're done for today. Thank you for watching, and I'll see you next time.
everyone, my name is Emily. Today we will look at what influences the price movements of major currency pairs. Currency pairs are influenced by geopolitical events, central banks' interest rate decisions, and macroeconomic data. For example, the Federal Reserve, the central bank of the US, maintains financial stability by increasing or decreasing the discount rate. The Fed sets target interest rates at which banks lend to each other overnight, but it also sets the discount rate, the interest rate at which banks can borrow from the central bank. If the Fed raises interest rates, it increases the cost of borrowing to slow down the economy. On the contrary, in order to stimulate the economy, the Fed lowers rates, making borrowing cheaper and encouraging spending on credit and investment. Economic releases such as major economies, CPI data, non-farm payrolls, gross domestic product, retail sales, purchasing managers, index, and others can influence the value of a currency and create volatility. Politics, trade wars, elections, corruption scandals, and changes in policies can create political tensions which can influence the forex market. For example, Brexit and British or American elections have been major events in recent years which have affected both the political and financial spheres. Traders who are new to forex trading tend to choose liquid currency pairs like the euro against the USD or the USD against the JPY. They also spend a significant time on researching and learning the forex market and the currency pairs they are interested in by analyzing technical charts and monitoring economic data. Choosing the right forex trading strategy, cultivating discipline, and eliminating emotion are also important. Depending on your schedule and lifestyle, you can also choose the right time to trade, which will also determine your trading. You can choose from swing trading, day trading, or scalping. Whatever currency pair you choose, or what style you decide to follow, ensure you have a solid education and learn as much as you can about the market you want to trade. Thank you so much for watching us, guys. Bye-bye.
All right. Okay. Before we kick things off, let's quickly go through the risk warning and disclaimer as well. Do take note that all the products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. Right? These products may not be suitable for everyone, and you should ensure that you understand the risk involved. All right. Do take note of the disclaimer as well. The information in this webinar should not be considered investment advice or investment recommendation, but instead educational material only. All right, so my name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, so today's webinar series will be the first part of the Fibonacci series. So we'll be looking at retracements. So we'll start off with the basics. Of course, we'll look at how do we identify an ideal market structure? How is it different from something that's non-ideal? Why is that important? Because when we are trying to use the Fibonacci retracement tool, we should be looking for ideal market structure or something that resembles as closely as possible to an ideal market, right? Being the real life world, nothing's ever ideal when it comes to market structure or price action, but we are going to look for something that's going to be as close as possible to the ideal structure. Then we will look at how we can follow the market structure so as to achieve good or to achieve significant Fibonacci retracement levels, right? When we do not use the Fibonacci retracement tool correctly, and when we do not follow the market structure as closely as possible, then the retracement levels that are highlighted by the Fibonacci retracement tool will not indicate significant resistance or support levels, right? So that's the basics. We are going to identify what is an ideal market structure, what type of price structure in reality mimics the ideal market structure, and then how to follow that, and how do we draw the Fibonacci retracement from the starting point to the end point. Then we'll also look at the various Fibonacci retracement levels. Then we'll also touch on the negative Fibonacci levels as well as the levels that are greater than 100%. All right, so if you have any questions along the way, do not hesitate to drop your questions in the Q&A box or the chat box. I'll be more than happy to go through your questions should there be any doubts along the way. All right, so let's start off with the ideal market structure. What is an ideal market structure? Well, first of all, we'll start off by looking at what is wrong, right? Okay, so when we are trying to draw a Fibonacci retracement, we're looking for significant swings, right? So we're looking for market swings, so like a swing high or a swing low, right? In this example here, what we are seeing, this GIF is showing us an example of insignificant swings, right? So you can see here, I'll just label it, this is number 1, this is number 2, right? So swings like these are pretty insignificant, right? And also here, looking at here, 3, this is a swing high, 4 and 5, right? When you look at 1, 2, or even this one here, let's label this 6. You can see this swings, all these swing highs here, these are the highs. They're all pretty insignificant. So we're not looking for these sort of insignificant swing highs, right? Similarly, when we look for the swing lows, you look here, A, B, C, D, right? These are insignificant swing lows, right? So we're not looking for this type of market structure where the swing highs and swing lows are insignificant. This is pretty noisy, right? To a certain extent. So what we're looking for in a market structure that will have significant swings. Now, this can be swing highs and swing lows, of course, right? So now that we've had an example of what is or what are insignificant swings, let's move on and try and see how do significant swings actually look like, right? Okay, now here we have a GIF showing us examples of how to identify significant swing highs and significant swing lows, right? As you can see here, we need to look for significant swing highs and lows. So clearly we can see here, point number 1 is a significant swing high. Point number 2 here is a significant swing low. Point 3 is another significant swing high. Point 4 is another significant swing low. Point 5 is a high. 6 is a low. 7 is another high, right? So this GIF is clearly illustrating how do we identify significant swing highs and lows in market structure, right? So you can clearly see this is a swing high here, 0.1. This is a low, high. Number 4 is a low, 5 is a high again. 6 is another low, and 7 is a high, right? So do take note. This is how, this is the type of market structure that we're typically looking for when we're trying to identify swing highs and swing lows, because that's very important. That's basically the main foundation of Fibonacci retracements. We need to identify the significant swing highs and swing lows so that when we actually use the retracement tool and we draw the Fibonacci retracements, we are going to get retracement levels that would actually function as, or that would potentially function as very significant resistance or support levels, right? So what we're trying to do is increase the probability of these retracement levels functioning as a significant support or resistance, right? If you don't draw the Fibonacci retracement in the correct manner, the subsequent retracement levels are very likely not to yield any significance, right? Be it as a support or resistance, okay? Right. Now, how do we follow the market structure? Right now that we've identified significant swings, highs and lows, now how do we identify, how do we follow the market structure when we use the Fibonacci retracement tool? So as we can see in this GIF here, point 1 is clearly a significant swing low. That's fine. That's great. Point 2 is also a significant swing high. Point 3 is another significant swing low. And point 4 is another significant swing high. But in this example, they're drawing the Fibonacci retracement starting from point 1, but going all the way up to point 4. As you can see here, the highlighted diagonal line, right? You can see the highlighted diagonal line is going to come up again. Now that highlighted diagonal line in blue, that is the trend line of the Fibonacci retracement tool, right? Fibonacci retracement tool. So when we start Fibonacci retracement, we always start from the left to the right. So when we're doing it for the upward part of the move, we're always going from bottom left to top right. Similarly, when we draw the Fibonacci retracement for the downward move, we're going to go from top left to bottom right. So do take note, this is another key aspect of how to use the Fibonacci retracement tool. We always go from left to right. So if it's an uptrend, if market structure is going up, right, we always go from point 1 on the bottom left to point 2 on the top right. Similarly, when we have a market structure that's showing a strong downturn, we're going to go from point 3 to point 4. That means we're going to go from top left to bottom right. Remember, Fibonacci is always left to right. Yeah. Whenever we are drawing the Fibonacci retracement tool, be it for the upward move or the downward move, we always go from left to right. So for the upward move, for the uptrend, we're going to go from bottom left to top right. And for the downtrend, we're going to go from top left to bottom right. Okay, that's another key aspect of using the Fibonacci retracement tool. All right, now going back to that trend line, remember I was talking about that can you see here, this highlighted in blue, this trend line. Now in this example, they've started this Fibonacci retracement starting from point 1 and ending it at point 4. We can clearly see that the trend line is not capturing the market structure at all, right? We can see that there's plenty of gaps to the top of the trend line as well as to the bottom of the trend line. So in this type of market structure, the ideal Fibonacci retracement, right, to be drawn would be from point 1 to point 2. So when we draw it from point 1 to point 2, we can see that the trend line will capture the market structure much better than from point 1 to point 4. Similarly, when we're doing it for the downtrend, we'll start from point 2 to point 3. And when we do that, the trend line will capture the market structure very closely. So that's what we're looking for. We're looking for the trend line to capture the market structure as closely as possible, be it to the upside or to the downside. So that's how we know whether we've drawn the Fibonacci retracement using the correct starting and ending points. Do take note, if the trend line does not capture the market structure very well, that means it's quite likely we have not used the ideal starting and end points for the Fibonacci retracement, right? Okay, let's go on to the next slide. Now here, we can see we've identified point 1 and point 2. Point 1 is the starting point. Point 2 is ending point. And you can clearly see that the blue trend line has captured the market structure as closely as possible. Of course, there are going to be a little bit of gaps to the downside and to the up of the trend line, but in general, we can see that this trend line has captured the market structure very well. Now, similarly, if we had drawn the Fibonacci retracement from point 0 to point 1 here, right, we would have seen that the trend line would have captured this market structure very well as well, right? Would have captured this market structure pretty well, right? So this is what we are trying to emphasize and highlight. So be it for an uptrend or a downtrend, Fibonacci retracements, we always go from left to right. For the uptrend, so bottom left to top right. And for the downtrend, we start the retracement from the top left, and we end at the bottom right. Right, and the other aspect to take note of, or the important point to take note of, is the trend line must capture the market structure as closely as possible, be it to the downside or to the upside. All right, great. Okay, let's move on to the next slide. All right, so now that we've had a quick look of how to identify ideal market structure, how to identify significant swing highs and swing lows, and also we've also seen how to draw the Fibonacci retracement in a manner that is going to give us significant retracement levels, right? We have to start, we have to identify significant swing lows here. You can see 0.0 is a significant swing low, 0.1 is a significant swing high, and 0.2 is another significant swing low. And similarly, when we choose the most ideal starting and end points, the blue trend line is very likely going to capture the market structure very closely, right? So do take note of that. All right, okay, with that, now we're going to look at the various Fibonacci retracement levels. Okay, for those of you who may be aware or have used the Fibonacci retracement tool before, so we know that this goes from 0 to 100, right? 0 to 100%. Right, so the retracement levels as highlighted here, as you can see, or well, not highlighted, but as described in this image, you can see that the retracement levels run from 0% to 100%, right? So the key retracement levels are at 23%, 38.2%, 50%, the golden ratio of 61.8%, and the 78.6%. So there's 1, 2, 3, 4, 5 key retracement levels, right? So when we talk about the Fibonacci retracement levels, we're talking about the 5 key retracement levels running from 0 to 100, and they are, right, 23%, 23.6% to be precise, right? 38.2%, 50%, 61.8, which is the golden ratio, of course, and we end up with 78.6%, right? So do take note, these are the 5 key retracement levels: 1, 2, 3, 4, 5. 23.6%, 38.2%, 50%, the golden ratio 61.8%, and of course the 78.6%. Now, in this example, we have started this retracement from 0.1, the starting point 0.1, right? And the ending point 0.2. So do take note, Fibonacci retrace, the starting point of the Fibonacci retracement will always indicate 100%, and the ending point will indicate 0%. So conversely, if I were to draw the Fibonacci retracement from this part here, let's just identify this swing low as 0.4. Now, let me just tidy this up a little bit. Right, let's just identify this swing low as 0.3 and this swing high as 0.4. So when I draw the Fibonacci retracement starting from 0.3 to 0.4, my starting point is going to show me 100%, and the ending point is going to show me 0%, right? Just like how we see here on this downtrend, right? On the downtrend, we start from top left and we end at bottom right. Conversely, for the uptrend, we start at bottom left and we end at the top right. So starting point is always 100% and ending point is 0%, right? And the key retracement levels, like I said, are the 5 key retracement levels at 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Now, in this example, we're also showing Fibonacci levels that are greater than 100% and lower than 0%, right? So the negative retracement levels are the key retracement levels at the negative point are negative 27.2 and negative 61.8%. We'll touch on this a little later. Similarly, extension levels that are greater, Fibonacci levels that are greater than 100%, the key levels are at 127.2% as seen here, and what is not seen is at 161.8. But for now, let's just focus on the retracements, right? So 23 to 78.6, right? So as I mentioned, we started at 0.1. We started this retracement, right? We started this retracement at 0.1, 100%, and we end at 0.2, which is 0%, right? So we can only start this once the price has formed the swing low. So basically, we're waiting for price to make this significant swing low here, come up here, maybe the first after the first 1 or 2 candles or 3 candles, depending on your time frame. Let's just assume we are on the 4-hour time frame and we see 2-3 candles, at least 1 or 2 candles being formed after we see the significant swing low. That's when we can draw the retracement. So in this case, we're drawing the retracement from point 1 to point 2, and what the subsequent retracement levels at 23, 38, 50, 61, and 78.6, what these levels are going to highlight. These levels are what these levels are going to highlight are potential resistance levels. Do take note, when we draw the Fibonacci retracement for a downtrend like this, the subsequent retracement levels are going to help us identify potential resistance levels. All right. Conversely, when we draw the Fibonacci retracement for the uptrend, right, we're going to start from 100% and at 0. What the subsequent retracement levels tells us is going to highlight to us is our potential support levels, right? So we get 23.6%, 38.2%, 50%. So for the uptrend, the retracement levels are going to highlight potential support levels. And for the downtrend, the retracement levels are going to highlight potential resistance levels, okay? Right. So as you can see here in this example, 23.6% didn't offer much resistance, right? You could see price just stalling briefly here before going higher, where it does seem to have run into resistance. Okay, then after that 38.2%, we can clearly see price breaking above 38.2% as well. Where price failed to break above is at the 50% retracement, right? Clearly, we can see a price has failed to break above the 50% retracement. So this is a major resistance for price for this current example. So we can see just because we have a retracement level at 23.6% and 38.2% does not mean that price is going to stall at this level and reverse and drop lower, right? They are just points that are going to help us identify potential, right? What is important here, they are highlighting potential resistance levels. It doesn't mean that they will act as significant resistance levels, but what the retracement levels here are going to highlight is they are highlighting potential resistance levels. So, but in this example, you can clearly see 23.6% and 38.2% did not offer any major significant resistance. Where price did stall was under the 50%. So now we know for that 50% is a significant resistance level, and it's going to take something pretty like a strong catalyst for price to break above this level. All right, so do take note, the retracement levels highlight potential support or resistance. They do not indicate or they do not guarantee that these retracement levels are going to function as very significant support or resistances, right? Do take note. That's a very important, another important aspect of using the Fibonacci retracement tool. All right, okay. Moving on. All right. As I mentioned, the key retracement levels are 23, 38, 50, 61, and 78. Levels that are lower than 0. We also have Fibonacci levels that are lower than 0%. And we have Fibonacci levels that are higher than 100%. So we're going to get to those as well. All right, so the negative Fibonacci levels, right? So the negative Fibonacci levels are also known as expansion levels. You can see the key negative Fibonacci levels are negative 27% and negative 61.8%, right? These negative levels are also known as expansion levels, all right? So you may hear or come across this term, so do not be confused if you come across the term Fibonacci expansion or expansion levels, right? They simply refer to the negative retracement negative levels, which are at negative 27.2 and negative 61.8. All right. Okay. So these are the key retracement levels for the negative at the negative end, and they are also known as expansion levels. Now, how can we use this? Okay. How can we use these expansion levels? Well, first, right, you can see we started this retracement from point 1 here, and we ended at point 2, right? And we can also see 50% is here. So in order to use the negative levels or not rather to use, but for the negative levels to provide or to function as significant support levels, we actually need to see price retrace up to at least 50 to 61.8%, right? Do take note, price must retrace, right, after forming this low here, this significant swing low here. Price must retrace to at least 50% or even better 61.8%, so that when we see a market structure like this, and then should price reverse and drop lower, breaking under the 0% or the ending point, that means that these negative levels are expansion levels at negative 27.2 and negative 61.8% Fibonacci are going to potentially function as significant support levels, right? So do take note, this is another key aspect when using the expansion levels. The Fibonacci, the market structure must retrace up to 50 to 61.8%. It must, right? So at least 50%, and then should price reverse and drop lower, breaking under the ending point, that means negative 27.2 and negative 61.8 are going to potentially function as significant support levels, okay? This is a very important aspect, because if price only retraces up to 38.2% and then stalls and reverses to drop lower, that means this levels here at negative 27, negative 61 may not offer significant support, right? Do take note, this is one key criteria, right? The key criteria is the retracement has to come up to at least 50%, right? The retracement has to come up to at least 50%. I'm talking about this retracement here, right? It has to retrace up to at least 50%, even better if it comes all the way up to 61.8. And then as it reverses to drop lower, the expansion levels are then likely to function as significant support. All right. Okay. Now, in this example, we can see clearly that price has retraced to 50 and has even reached 61.8%, right? And then has now started to reverse and drop lower. Now, so how can we use these expansion levels? First off, as price starts to retrace to drop lower, we can also use the 0%, for example, as a potential take profit level, right? So if you go short on this position here and price is reversing, right? Perhaps there's a strong bearish catalyst that has a combination of a strong bearish catalyst, and your technical analysis is telling you this is now a potential short entry, where you would identify your take profit would be potentially here at the major swing low here at 0%. And should price continue to break lower, you can identify your second TP or take profit at the negative 27.2%. So, right, this is where we can this is how we can use the negative Fibonacci levels or the expansion levels to help us identify potential take profit levels for the short side, right? So in this example, you're seeing it for the short side, for a potential short trade, right? So typically, in this scenario, price will, if price breaks below this swing low here, it will typically find support at negative 27.2%. And usually it does bounce off this level to return to 0%. So do take note. So this is how we can use the negative 27.2% Fibonacci expansion level to help us identify a potential take profit on the short side, or for the potential short trade, right? Okay. With that, okay, now we're going to look at Fibonacci levels that are greater than 100%, right? The key Fibonacci levels that are greater than that are greater than 100%, as I mentioned earlier, at 161.8 and also at 127.2%, right? These are the two key significant retracement levels. Extent levels that are greater than 100, and these levels that are greater than 100, they're also known as Fibonacci extensions. All right, do take note. Right, so if you come across the term Fibonacci extension levels, it is simply referring to levels that are greater than 100%, and they're specifically referring to 127.2% and 161.8%, right? Just like for the Fibonacci expansion levels, so similarly, if you come across the term Fibonacci expansion levels, they're referring to levels that are that are the negative levels, and specifically referring to negative 27.2 and negative 61.8. Okay, so expansion levels are negative, also known as the negative Fibonacci levels, also known as Fibonacci expansion levels, and the Fibonacci levels that are greater than 100% are also known as the extension levels. And the key extension levels come in at 127.2 and 161.8%. All right, so in this example here, right, we see price from this starting point here, point 1 making the swing high here, and then point 2 has made the swing low here. So how we can use the extension levels is we can use these extension levels to help us identify the take profit, a potential take profit I identity zones, sorry. So in this case, you can see price has made this Nike tick structure. You can see this Nike tick structure, right? We all know the company Nike and its logo, which is the tick. And you can also clearly see a price, this market structure here is following this Nike tick structure. So what we see is, or how we can use the extension levels is when we see price reverse strongly and come back up to the starting point, which is at 100%. Here we can say we're looking for potential bullish breakout here, right? We have our technical indicators telling us that this is a strong bullish move. We also have a strong fundamental data catalyst that's driving this move as well. So we are looking for potential bullish breakout. So when price breaks above 100% here, how we can use the extension levels is we can use them to identify potential take profit. So for example, 161 here has been identified here, and 127 is probably somewhere around here. So we can use these extension levels to identify potential take profit. So this could be the second take profit zone, whereas the 127.2% would be the first take profit zone, right? So this is how we can use the extension levels to help us identify potential take profit zones should price break above the 100% or the starting point and continue to drive higher. And then from here is where you could potentially is to identify a major resistance level. And from here, you could also potentially initiate a short trade idea as well. Because when you see price failing to break above the 161.8% extension level, it is quite likely it is going to drop lower. So as price moves away from this extension level and starts to drop lower, you can initiate a short entry, and your stop loss will be placed slightly above the 161.8% Fibonacci retracement to give us a little bit of a buffer, right? To give us a little buffer. So should price retrace back to the 161% as you can see here, but because we've kept our stop loss slightly above the extension level at 161%, it allows us to remain in the trade, and should price continue to drop lower, we can benefit from this potential short trade idea as well. So you can see how the extension levels can be used to identify potential take profit zones to the upside. And then once it hits 161.8% Fibonacci retracement extension, and then it starts to pull away, you can also consider initiating a short trade idea where you put the stop loss slightly above the 161.8% Fibonacci extension. All right. Okay, great. Let's see. Right, okay. We've come to the end in terms of my slides. So what are we going to do? What we are going to do now is we are going to move over to trading view and try and find examples of how to use the Fibonacci retracement tool correctly, right? So we're going to start, of course, just start off with the basics. All right. Okay. So here I am on trading view. I'm on the 4-hour time frame, and I'm going to use the dollar index as an example. Right. So first of all, we're going to try and identify significant swing highs and swing lows. So let's just do this exercise together, right? So just to take note, when we are using Fibonacci retracement tools, they generally work better on the higher time frames, right? So they generally work better on the 1-hour time frame and above, right? You can use them on the lower time frames as well, 30 minutes, 15 minutes, but they may not offer the same level of support or resistances as when we use them on the higher time frames. So do take note, about this aspect of using Fibonacci retracements, right? They do tend to work better on the higher time frames, such as 1 hour and above. All right. Okay, so first of all, we do a simple exercise on trying to identify significant swings, right? As we saw in the slides earlier, right? We saw examples of insignificant swings, and now we're going to look at examples of significant swings. So this is I'm on a 4 hour time frame for the dollar index, DXY. My chart is showing the price structure from end of September all the way to present time. So I think it's quite clear by now where the significant swing lows and swing highs, right? So, right, you can see here this is a significant swing low here. Okay, maybe hang on. Right, let's start off with swing highs. We can see this is a significant swing high. This is also another significant swing high here. This is another significant swing high. This is another high. This as well. This as well here, right? So 1, 2, 3, 4, 5, 6, right? These are generally how we would identify significant swing highs, as this one here as well. So the red circles are, I'm highlighting the significant swing highs in red. And now I'm going to highlight the significant swing lows in green. So you can see here, this is a significant swing low. This is another swing low here as well. Here, 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 and of course here, right? So what we're actually trying to look for, right, is I'm going to now just use a different color. So we're going to look for significant swings, right? So you can see when price makes a very strong V-shaped move here like this, as highlighted in the orange line, right? We can see that this is a very significant V-shaped move, right? And this tells us this is a significant swing low, and this is a significant move. Similarly, right, when I draw the swing high from here, we can see this is an inverted V shape, right? We can see a very clear significant swing high with a strong inverted V shape as well. Similarly, for this downside, we see a strong V shape here. And then for this swing high here, we can see generally the pattern I'm trying to get at. You can see that this is another inverted V. Similarly here, this is a strong V shape pattern here, swing. Another strong inverted V shape here. Another strong inverted V shape here. Strong V-shaped pattern here to signify the significant swing low. Another one here, inverted V-shape to indicate the swing high. Another strong V-shaped pattern here to indicate the swing low. And this high here, low here, high here as well. This is also a pretty significant swing low bounce here. And of course, this significant swing low over here. Right, so you can clearly see how we can identify major swing highs and swing lows, right? That's important, right? So as you can see here, I'm just going to leave this on for a bit before I erase it. So you can clearly see the green circles highlighting the significant swing lows, whereas the red circles are highlighting the significant swing highs. And you can see by my orange V shapes as well. We see an inverted V shape as well as the regular V shape that show us the size of the move, right? We're looking for significant swings and lows and highs, and the size of the move can be is highlighted by my orange brushes, right? You can see that the moves are very significant. So this is how we identify swing highs and swing lows, so that we are able to identify ideal starting and ending points for the Fibonacci retracement, right? Okay, so now I'm going to clear all of this, and I'm going to show you how we can draw the Fibonacci retracement for these swing highs and swing lows. All right, so we'll start with here on 29th of September and we'll end here on 3rd of October. Okay, so for those who may not be familiar with the Fibonacci retracement tool, the icon looks something like this, right? So you'll see 4 lines and you'll have the bubble here as well, the circle here on the left and on the right. So if you highlight it, it'll show you depending on whatever platform you're using. But if you're using a trading view, right, if you highlight over this icon here, it'll tell you Fibonacci retracement. So that's what you want to use. So we click on that, and we're going to start with the absolute low point here. Okay, So I'm just going to zoom in a little bit. Right, so I'm going to just zoom in a little bit. So this is my starting point, right? So remember, for this is an uptrend, so Fibonacci retracement always goes from left to right. Since this is an uptrend, we're going to start from the bottom left and we'll end at the top right. Okay, I'm going to pull up all the Fibonacci levels here. So this gives me the negative levels, the positive levels. Remember, negative levels are called expansion levels, and levels greater than 100 are called extension levels. Okay, right. Okay, but with that, I'm just going to focus on the retracement levels in this example, right? So as not to overcomplicate things. So I'm going to get rid of the extension levels as well as the expansion levels, right? And we're just going to deal with the retracement levels going from 0 to 100%, right? So then this is much more clear. So when we draw the Fibonacci retracement from this uptrend here, bottom left to top right, and as price is coming down, these retracement levels are going to potentially are going to highlight potential support levels, right? Now, whether these levels truly function as significant support levels, we can only tell when the move plays out. But generally, it does help us to identify potential support areas. So as price has made this swing high here and started to come down, we can see that price did find decent support at a 23.6%, retracing higher before falling lower. Then again, you can see here, it did find a little briefly found support here at 38.2%, again at 50, then also pretty strong support here, 61.8%, 78, and then finally 100 down here, right? So you can see clearly in this example here, price did seem to find support at almost nearly every single retracement level. Now, this doesn't always happen to be the case, right? There, as we saw in the slides, right, there can be cases where price will just simply break through the 23, 38, maybe even the 50, and then find support at the 61.8%. So do take note, in this example here, we do see price to have clearly found support at each of the retracement levels, right? Okay, this was an example for the uptrend. Now I'm going to draw a Fibonacci retracement for the downtrend, right? So this was the uptrend, bottom left to top right. We can clearly see here, this is a strong move down. We have a nice significant swing high here on 3rd of October, and we have a significant swing low here on the 12th of October, right? So we're going to start this retracement from here. Remember, whether it's a uptrend or downtrend, we always go from left to right. So since this is a downtrend, we'll start from, hang on. We'll start from the top left and we'll end down here on the bottom right. So in this example, we can clearly see price has broken through 23, 38, and 50% very easily, right? Very easily. These retracement levels here did not offer a hint of resistance at all. Where it did finally run into resistance was at 61.8%, right? And then after that, over the next half a day or so, price briefly broke above the 61.8 as well before dropping lower. So you can see where price found major resistance in this example is at the 61.8%. Do remember over here when we did the Fibonacci retracement on this uptrend here, we could see price finding support at every single retracement level. However, for this part of the move, we can see where the only level that offered serious resistance was at the 61.8% Fibonacci, right? So you can clearly see no two Fibonacci retracement is going to behave the same way, right? We are never going to see the same retracement levels functioning as a major support or resistance, right? Every swing high and swing low, or every uptrend and downtrend is going to be different, right? So do take note of that. There's nothing set in stone with regards to the Fibonacci retracement levels. It could be a case where the retracement levels offer support or resistance at every single level, or there could be a case like what we're currently seeing, where only the 61.8% has offered significant resistance. All right. Okay. So here we can see price running into resistance 61.8 on 12th of October, 13th of October, as well as 19th of October, right? Okay, so these were the two examples of how we can use how we can draw the Fibonacci retracement for an uptrend and downtrend. All right. Okay. Now let's move over to somewhere to where price is currently trading, right? Let's see where price is currently trading and perform some technical analysis here using the Fibonacci retracements. All right, okay. So once again, before we try and draw the retracements, let's do a simple exercise where we can try and identify the significant swings, right? Okay, so this is a green. All right. So we can see here, this is a pretty significant swing low here on 29th of November. Another significant swing low here on 15th of December. This significant swing low here on 28th of December. So when we look at end November till now, we can see 3 significant swing lows when we're on the 4-hour time frame. All right. Okay, now I'm going to try and identify significant swing highs. Right. You can see here, this portion here is a pretty significant swing high here. And over here, okay, price has not yet played out, but you can generally see the top of this wick is another significant swing high as well. Right. Okay, so let's just say, okay, let me just okay, I'm just gonna highlight my points so it's easy to refer to as well. All right, so let's work with points 1, 2, and 3 first. All right, let's work with the first 3 points. All right, so we have identified our major swing highs and swing lows. But let's just focus on the first 3 points. So for this upward trend here, we would be actually technically we would have highlighted this as 0.2 because as price was pulling down, we have highlighted this as 0.2. So we'll take this in step by step. So we'll start the retracement for this uptrend here from 0.1 to 0.2, right? You can see here in this example, as price was pulling back, 23.6% did not offer any support at all. 38.2 not really, because we can see the wick extending way beyond the 38.2 and even dipping below the 50%. So where it did find support here in this example was around the 50% Fibonacci retracement, right? As we can see here, the body of the candles actually closing underneath the 38.2%. And we can also clearly see the wick extending beyond the 50. So where price did find support in this example was at 50% before going higher. And as price comes up here, right, when a new high is made, we cannot use 0.2, the original 0.2 anymore. If we do wish to use the Fibonacci retracement, we have to move our ending point now because this is a new high. We have to move it to here, which is, yeah. And in this sense, you can see the trend line, right, is capturing the market structure quite well, right? It's not in what is not as ideal, as perfect as what we saw here at the first go. You can clearly see the trend line has captured the market structure very well. But even when it makes this second high here, you can see that the trend line has captured the market structure quite well. So we can still use this. So similarly here, 23.6% did not offer any support. Where it did find support was this time round at around the 38.2 before retracing higher and then finally smashing through all the other levels. You can clearly see here as it smashed through 38.2, 50%, 61% offered no support. Where it did find support briefly was at around the 78.6% Fibonacci retracement. All right, you can clearly see how the retracement levels help us to identify potential, right? The key word here is potential support levels or potential resistance levels, right? Nothing is set in stone. It doesn't mean price has to react off each level. but it's just helping us to identify potential support or resistance levels. Okay. Now, after price has come down here, it has found support around 100 and 190 before proceeding higher. So now we have 0.2 and 0.3. We can also run a Fibonacci retracement on this downturn. So we'll start from here, 0.2, 11th of December, going down to 0.3, which is the 14th of December. So in this case here, we can see as price was retracing higher, these retracement levels are helping us to identify potential resistance areas or zones, but we can clearly see 23.6% offered no resistance. Where it did run into resistance was around the 38.2%, right? 38.2% was where price found resistance before dropping lower. And you could see from 18th December all the way till 3rd of Jan, right? This price failed to break above this level until just recently last week. Okay, so this is how we can use the levels here. Now, as price comes down here, right, we can see now this, I would use this as let me highlight this as 0.4, right? So you can see here, this is a pretty significant swing high. This is a significant swing low. So if I were to extend this Fibonacci retracement, right, I go from 2 to 4, right, we can see that the market structure, the trend line has captured the market structure quite well, right? Quite well. Some would argue that because this has drifted too far, I would not use 0.2 as a starting point, but rather I would try and use 0.3 here, for example, this point here. Okay, here the market structure, the trend line captures the market structure a little bit better, but even here, I think to me, this is still pretty all right, right? This is still pretty all right here. You can see at this part, especially the beginning of the move, the trend line captures the market structure very well. And the second half of the move, it captures it pretty well as well. It's only this bit here. So as price is retracing higher, we can see clearly 23.6, 38.2, and 50% retracement levels offered no resistance at all. Where it did run into resistance was around the 61.8% Fibonacci retracement, right? So you can see here, this retracement levels are just going to help us identify potential resistance, but you actually have to see where price is actually going to run into, right? So you can see here, because this is also an overlap, a pretty strong resistance level here, right? As price retrace higher here in 18 December, this forms a pullback resistance, right? This forms a pullback resistance level. And you can see price actually running into resistance here on 3rd of Jan, right? It broke above 23, 38, and 50 very easily, but it actually stalled at around this resistance level here at 102.64. And also we can see how the 61.8% Fibonacci retracement has also helped us to identify another strong resistance zone above this pullback resistance. Okay. And now, okay, I'm going to label this as 0.5. So in this case, I'm going to run the Fibonacci retracement from 0.4, this swing low, ending with this high here at 0.5. Now, as price is let me get rid of this. Right, now as price climbed as high as or briefly going above 103 and then pulling back sharply, you can see that as it was falling down, 23.6% offered no resistance. 38.2 is a level where we did find a little bit of resistance, right? But actually, you can see it actually go beyond. So where it found support, where it found support was slightly above 50%, right? So the major support for the dollar index now is actually at around 102.10. And we can also see that 50% is still also still suggesting another strong support zone should price break underneath 102.10, right? So do take note, these are the key support and resistance levels of course, now with price breaking above it, I would have to adjust my resistance to this level here. I'm going to use the body of the candle so we can see the major resistance at 102.74 and major support at 102.10. All right. So so we've covered Fibonacci retracements today, which is part one of the Fibonacci series, masterclass series, right? So do look out for part two coming up next week, right? So where we will be building on retracements, right? We covered a little bit of extensions and Fibonacci expansions today as well. Do take note, expansions are the negative levels and extensions are the levels greater than 100. We covered a little bit of that as well. And in part two, we're going to delve a little bit more deeper into them. All right. So just to recap, today we had Fibonacci retracements. Do remember we're looking out for significant swing highs and swing lows, right? Such as these, right? We're looking out for significant swing highs and lows. Where did it go? Where's my brush? Right. Such as these, right? This is a significant swing low. This is a significant swing high. Another significant swing low. Also another significant swing low and swing high. So do take note. It is important to identify a good or ideal market structure where we can clearly see the significant swing lows and the significant swing highs, so that when we draw the Fibonacci retracement tool, we're actually going to get uh, uh, indication that these retracement levels are going to offer significant support or resistance. And do take note that the trend line has to capture the market structure as closely as possible. All right. Okay. So we've come to the end of today's webinar. Thank you all for tuning in. Do look out for next week's Fibonacci series part 2, right? And do register for that as well. All right. Take care. Have a great trading week and enjoy your weekend as well. All right. Thank you, everyone. And I'll see you guys next week. All right. Take care.